Silver's telling us something. We're going to find out what it is. I have invited Jim Iuorio onto the program. He's a veteran professional, or he's a veteran options and futures trader. Lots of experience in the market, and we're going to talk about whether it was China inflicting or abandoning their zero COVID policy. Is Silver taking something away from the Fed meeting tomorrow and the FOMC sort of statement from Powell that we expect? Let's find out. Let's talk to the pro, and thank you for joining us. Right now, welcome, and I'm really excited to be. Hold on. It doesn't look right. It doesn't look right on my end. I don't see you on here. I screwed something up. Hold on. What did I screw up?
My camera's on, but I'm not.
No. Exactly. I forgot to pin you. Oh, I saw you in Zoom. I forgot to pin you. Okay. Perfect. Okay. There we go. I forgot to pin you in Zoom. So I'll leave the intro. I'll just cut that middle part out. I'm still recording, so welcome now to SF Live. I'm joined by Jim Iuorio. Jim, it's great to have you on the program. We saw each other briefly in New Orleans. Didn't have a chance to chat there. It was fully booked. It was insanely busy. Thought it was an amazing conference. It's great to have you on the program now. Good to see you.
Thank you very much, Guy.
Yeah, we've seen each other at a couple events there around the conference, but I heard lots of good things about your presentation as well, because it was different. You weren't talking about gold and silver. You made an effort to talk about copper. And I think that's where we should sort of start our conversation, because I think I'm a big fan of copper, personally. I see the use of it. I see where it's headed, and I see a massive crunch coming up. So I'm curious now what your whole point of the presentation was and the key takeaway, obviously.
The key takeaway was is that I think there's this confluence of things that's creating a very, very rare opportunity in copper. And one of them, obviously, is an aggressive Fed that continues to raise rates, which, so raising rates, obviously, you guys, and most of the people watching this know the metals market. Metals market hates higher rates because, they pay no yield. So the higher the yield goes, the more costly it is to carry them. The metals market hates higher dollar, keeps screaming higher during the Fed's rate cycle too. But there was a third element that I think that was affecting copper that is really quite interesting to me. And that was the intermittent aggressive lockdowns in China. And the copper market is always very closely linked to China. Now, once a link like that is established in the trader world, the actual facts of it, how much copper is really being imported by China, how much of the demand is there or not there, doesn't matter as much as what the perception is. And the perception will move markets. And I think every time it came out with a headline that China was locking down again, the copper market suffered. So I think you have to ask yourself two questions about the copper trade. Is the length of time the Fed's going to be overly aggressive like they are finite? I believe the answer to that is yes. And is the COVID intermittent lockdowns out of China going to be finite? The answer to that, I believe, is yes, too. I don't think it's as clear. Like if you ask me when the Fed's going to be done, I say the Fed's going to be absolutely done within the next quarter. And I think I'm probably a little aggressive on that. But I would guess, and it's much more of a guess with China, but I bet that nonsense will be done within the next 2 to 3 quarters. And then all of a sudden, the underlying story for copper, which is we're already operating at a deficit, any push toward decarbonization must have copper as the linchpin element in that. And also the great conflict between the environmentalists who want decarbonization and copper, and they also hate the extraction process. And that's not just in our country, but even in other countries too, like Chile, which is the Saudi Arabia of the copper market. Permits now to expand drilling are like 3 times more cumbersome and time consuming to get than they were only even 10 to 15 years ago.
No, absolutely. And how do you play the copper market right now?
So there's a couple different ways. I'm a futures trader, so I'm going to be looking specifically at futures. And the chart still on copper is telling us that it's not my time yet. The chart still looks bad. It still looks like it has room to go on the downside. I'm not sure it'll go on the downside, so I'm staying out of it until a couple things happen. I want to see a weekly settlement above the 380 level in copper futures. Now, there's a couple different ways. At that point in time, I plan on being long copper as a core position and trading from the long position too. The CME has trading vehicles like the micro copper contract that you can trade around your core position as well. Now, some people, by the way, I trade individual stocks all the time. I can neither buy nor sell recommended individual stocks because of my licensing, because I have a team of lawyers that calls me and screams at me all the time whenever I slip with that. But there are some big U.S. companies. I have a long position of Freeport McMoran, which I'm not recommending to anybody. However, they pay a dividend. The copper miners, as you know, if you're right and copper's moving higher, they will move higher faster just because of that. Their operating costs stay mostly the same and their margins increase as they go up. So it's kind of like a leveraged play on copper, which, by the way, that works on the downside as well. Everyone who's involved in the futures market will say, well, if you have opinion on copper and you have opinion on crude, why don't you just trade copper and crude? And it's not quite as simple as that. There's pros and cons with both of those things. I probably will be primarily trading in the futures market with CME copper futures and copper micro futures.
Gotcha. Makes a lot of sense. How does a recession fear sort of fit in? And maybe to extend on that question, are we even in a recession?
It certainly fits in. And I believe that if we're not in a recession now, we certainly are going to be in. And that I don't think that should come as that debatable point, considering that the Fed has told us they're going to destruct demand. They're going to take care of the slack in the labor market, which basically means we're going to force the unemployment rate higher. So if you look at that last GDP number from last week, which this is really, really interesting to me, because the headline of the GDP number was 2.6 above an expected 2.4. So the initial reaction to the market was, oh, wow, it's better than expected. But then all of a sudden you tease out exports, inventories, government spending, and what's left is a number that's closer to recessionary. It was a plus 0.1. Now, there was a moment where I thought to myself, am I just teasing the number, massaging it to get my confirmation bias? And normally I would say there's a probability of that, but the Fed funds futures market told me the same thing. They pulled forward. They pushed back tightenings. The odds of an only 50 basis point tightening at tomorrow's meeting went from being about 3% to a high of 17%. Now they've settled back down to about 10% for tomorrow's meeting, which to me means that the Fed will go 75, which is fine. But the point I'm trying to make is that after the higher than expected GDP number, the market treated it like it was a lower than expected number. And I found that fascinating.
Yeah, no, absolutely. And still staying on copper before I pivot. I love that term, by the way. Before I pivot to the Fed.
You can't use that because pivot, does that mean the Fed goes to neutral? Does it mean they go to easing? Yeah, you got to watch that.
We're going to talk about that in a second, but that term might also be copyrighted or by somebody now because it's been used so much. But on copper, like how much really is and maybe even percentages is a recession priced in, and also that supply crunch that you're talking about? Because at 340, 350 a pound copper, it feels like equilibrium right now. People understand, okay, commodities are going to deflate in the coming months, or they should, at least based on history, financial history. But the supply crunch, is that factored in? And recession
the supply crunch is the bigger deal. When you start talking about recessions and future projections for growth, I believe that most of these markets are forward looking and price a lot of that in. And I believe what it means, and I think this is the most important thing too, is it means a Fed that could be less aggressive. And that's the thing that could lift all markets. Larry Kudlow, by the way, I'm not above name dropping, but Larry Kudlow and I were having a discussion on Saturday. And for 20 years, anyone who's been watching Larry Kudlow in any of his shows will always say, profits are the mother's milk of stocks. And I always say, I believe that's nonsense. I believe Fed and excess liquidity is not only the mother's milk of stocks, but the mother's milk of most of these assets. Most of these assets trade on the Fed now. I don't think that's a good thing, but I do think it's a reality. So I think once the Fed signals to us that it's moving to neutral or pivoting to easing, which the Fed funds futures curve says comes around late summer of 2023, that the Fed will actually be easing. That's when I think, as soon as we get some telegraphing by the Fed, which I think comes in the next couple of months, I think that's going to be the green light for buying metals, and that's when I plan to increase positions in it.
Yeah, definitely. That's what the market of gold, silver also tells us as well. If I look at the charts, I think we're waiting for that. But it feels like the Fed, I forgot who said it, but some Fed committee member mentions we might be softening the stance, we're only 50 basis points in December. And from what I've been reading in the financial media, it seems like the market was surprised by that statement. Sure. But here on SF Live, I've been talking with a lot of macro commentators, and we've been chatting about this for weeks. So it didn't come to a surprise to me. It's is there a ceiling? 4.5% seemed to be the ceiling, and then they said, okay, let's get to this level, and then we sort of see what is going on. Is that what you expect as well?
No, I expect a little bit lower ceiling than that too. Here's the issue that I have is that every one of us, not just me and you, but everyone who's watching this too, would be 100% willing to acknowledge that rate hikes and rate eases obviously have a lag effect before they're felt in the economy. That lag effect could be 6 months, could be 9 months, but there is a lag. So let's look at the real estate market where rates have gone from 3% to above 7% in about approximately 9 to 10 months' time. And we're already starting to see the destruction that those higher rates are doing. The new home sales number from the 26th came in as almost down 11% month over month. These are big numbers. So the point I'm trying to make is this, is that if the Fed is hung up on seeing the results of their handiwork before they back off, that'll be a statistical certainty that they will have overdone it, meaning that they would have gotten rates to the right level 1 quarter before that. So my point is this, is that I think the Fed is starting to make the realization that if they kept rates exactly where they are right now, continued with their quantitative tightening policy, made sure mortgage rates stayed in the level they are right now, would we be slowing down the economy enough to take care of this inflation at a certain amount of time? Well, of course we would. It maybe that amount of time is 6 months or a year, which they're not happy with. They want to do it earlier than that. But it's easy to say they want to do it earlier than that until they start seeing our economy skidding into recession. And that's when I believe they will change tune. And I believe that happens in the next couple of months.
Yeah, you brought up house sales. Of course, they slumped year over year as well. But and I read that as well because demand still outstrips supply. Prices are still going up, although sales are dropping. Is that do you expect sort of an inversion there?
Sure.
Like, it should happen any day now as well, I guess.
Sure. What happens there is pretty interesting, and it usually takes a lot of time to play out. But the supply issue with housing, remember, all of a sudden now people are faced with a different decision of whether or not to part with their 3% mortgage if they had designs on selling their current home to upgrade. So all of a sudden now those homes are being taken off the market because now there's reluctant sellers. There still was a supply problem even going into this over the last 10 years. There probably wasn't houses built at the same level that there should have been. So right now you're seeing those things pull against each other. But the overwhelming story is still the higher rates that are slowing everything down. Now, if you look at even the CPI number, they have the OER, the owner equivalent rents portion of it, which, by the way, is designed very, very poorly, and it tends to not show up for 3 months. Just to put it in perspective, housing prices cratered right in the great financial recession, and the CPI didn't really start reflecting that to almost a year and a half after it happens. Now, if you take in Zillow's more current rent data that they put out, it shows a much clearer picture that rents are rolling over and housing it has to roll over just based on the math of these higher mortgages.
Yeah, no, absolutely. I fully agree. And I'm sitting on the sideline waiting for at least the Vancouver housing market to crash so I can jump in and buy a nice property with a view.
By the way, so you said the word crash there. I don't believe the housing market crashes because I believe people my age saw what happened in 2006 to 2008 and think, oh, could that happen again? And the answer to that, in my opinion, is no, because at that point in time, we had decades and decades of market position buildup. And what I mean by that is, like, anecdotally, you'd be sitting at the Thanksgiving table and your brother-in-law's brother, who was an electrician, all of a sudden was a home flipper and owned 5 homes that he was rehabbing and flipping. And this took a long, long time to build up. I didn't see that in the 2-3 years previous to where we are right now. I do think a lot of people bought second homes, but buying a second home with not adjustable rate mortgages. Remember that back then we had these adjustable rate mortgages that were going to start adjusting. Well, everybody was locking in 30 years at ridiculously low rates, and they don't have 5 homes; they just have 1 or 2. To me, it's a much, much different equation. Do I think housing prices could come down 10 to 15%? Absolutely. But do I think we'll see the implosion of 40 to 50%? I think there's no chance of that.
Getting sidetracked, but I like the rabbit hole we're going down
Sorry.
for a second. I'm going to stay on topic for just one more second. But
then it's your fault.
No,
It's your fault.
absolutely. I'm taking for steering it in that direction. But with the housing market, I've been watching a lot of like FinTubers, right? Like finance YouTubers, and they brought on a lot of guests, watched a lot of podcasts in that regard, and a lot of them are like real estate moguls. Right? They all like, and you said you didn't see it. It's like, I think I actually did. And I want to contradict you a little bit. I've seen like people on Graham Stephan's show, or Graham Stephan, and he's done the Iced Coffee Hour, which I actually like listening to. And he had a lot of people on. He's like, oh, I got 100 apartments. And like one guy mentioned only one of his apartments has a 1% margin. Okay. And all of it was mortgaged. Okay. Like, so it's like, maybe like, because during the recession,
I will.
Okay,
no,
sorry.
I think what you're saying is valid as hell. I do think there's some position buildup. I was talking about the strata, about like, remember the movie The Big Short when the stripper owned 5 homes? And I know that they were just trying to make a point in that movie, but they were making a point that investment in real estate had filtered down to the lowest level. And it's like the old Joe Kennedy story about when his shoe shine boy was talking to him about taking all his excess money, putting it in the stock market. That's when he took his money out, because it was like every different level of society had bought into the bubble. And that's when, it was over. Now, what you're saying, I think there's plenty of leveraged hands that are going to suffer. And to me, that's why I think the 10 to 15%. But if you look at also too, remember 18% of the homes that were bought in the run-up were bought by like the BlackRocks, the investment trusts, things like that. So it wasn't exactly the same type of people who react the same to a margin call as perhaps your brother-in-law who's the electrician would.
No, interesting. Like I really like that discussion, because it's like I think the free money during the last 2-3 years sort of caused a big disbalance, and sort of we might have to rewrite history books, at least the financial ones, based on what we're thinking, what we're discussing. Even we might be, both of us might be completely wrong next week.
Sure,
like yeah. Absolutely. Or there might be a new term invented for what we're doing here anyway. So
yes,
great discussion. I'm loving where this is going. Let's talk U.S. dollar real quick before we talk silver, because I think it sort of ties together precious metals, U.S. dollar, because it really tight-knit relationship. Let's talk about what is actually happening today, and we're recording this on Tuesday, November 1st. I've seen silver accelerate, go up 4%. Gold was up, I think, at 1.5%. DXY was down, and then during the day, just as we're talking, silver's dropping, DXY is coming back. So I'm trying to make sense of that. And I titled the video, "What is silver telling us?" Could have titled it, "Gold is telling us." What is the DXY telling us right now? What is it telling you?
So what it's telling me is that we're worried about Jerome Powell tomorrow. He dropped the hammer once before at the Jackson Hole meeting, where the markets were believing that we were nearing the end. He wanted to make sure that the markets didn't keep believing that. So he hit us all over the head. I think all the markets, stocks, silver, the dollar, I think it's, like you said, it's Tuesday, November 1st. We've had moves in many of these commodities, particularly in stocks. And I think right now people are taking some money off the table in preparation of what could be a problem tomorrow. I think that's the biggest risk. Now, you mentioned before Mary Daly on October 23rd coming out and saying, we're starting to think about a time where we're stepping down. So the question you have to ask yourself is, was that calculated? Was that something that came from Jerome Powell himself? My answer to that is yes. And I think the markets tend to agree with me. And that's why the Fed funds curve has gone the way it is. That's why the stock market's rallied. That's why silver seems to have found a base. Gold is an interesting animal, and we can talk about it. I'd like to talk about silver more than that. But I think today what we're seeing is position squaring prior to tomorrow's number. Tomorrow's Fed news.
Interesting. Yeah, I find it, because again, the market seems to be surprised by the softening stance. We talked about this earlier. Like, I'm not surprised by it, and I'm surprised it hasn't been priced in, because we've been talking about this on this program for the last 3-4 weeks. But do you think there's a chance tomorrow that he catches us all off guard and says, "No, I don't know what the markets are thinking of, but I certainly plan on going 75, 75." Some people say that there is. Some people almost think that he's so dead set on taking wealth away that he has no problem with knocking the stock market down another 10 to 15%. And it almost, in some people's mind, not mine, seems like this is a setup to catch people leaning and for the pickoff play. And I don't believe that it is. I think that it would be kind of irresponsible for him to allow the markets to think that there's going to be some softening talk and then to ramp it up tomorrow. I don't think he will. No, it'll be tough. It'll be tough. But his statement saying that he wants to cause pain or needs to cause pain before a pivot as well, that sort of threw me off a little bit to see where things are going. And we'll have to see. I honestly doubt that. I don't know. I'm not no, it's not my area of expertise. Like I do the interviews, so to stay on to point there. But for silver, like what are you looking at? Are you trading silver actively right now? Are you?
Oh yeah,
yeah.
Sure. Yeah, I have position in silver that most people who follow me on Twitter know that's been uncomfortable. I believe in the fundamental story. I believe how it fits into the Green New Deal, and even in the Inflation Reduction Act. There's a lot of stuff about green energy going forward, and silver has to fit into that. Silver's been knocked down for a couple of reasons. One was the same as copper, higher rates, higher dollar too. I think it's silly of us to talk about precious without talking about the role that cryptocurrencies plays in siphoning some of the hideout money into those assets away from gold and silver. But silver I like better than gold, and I like it because of the industrial component of it too. But from a technical standpoint, what happened today was very, very fascinating, because the futures market it traded right up to the $20 level, which I think is technically very significant, and then it retreated from that. So that what that means to me is there's your level. That helps me come up with my trading roadmap. So right now, then I want to see a daily settle would be nice above that price of 20. A weekly settle would be even better. And then the next day or the next week, a little bit of follow through. And I think it's game on. I think B of A, some B of A metals, Des said a price of silver of $50. I don't know what his time frame was, but compared, when you look at the Green New Deal and the demand that's going to be for silver. And again, the demand is one thing, and the demand is an important part. But once the asset starts moving in a direction, buying begets buying, selling begets selling. It becomes a momentum trade as well, too. But I also think, again, and this is going to sound like a broken record, it all hinges on the Fed and the Fed softening up his rhetoric toward higher rates.
So maybe last question as well of our conversation. Let's talk about gold real quick. You said you don't like it as much as silver. Why is that? Why aren't you looking at it, or why aren't you as excited?
So the gold trade is obviously, in my mind, it's always precious to industrial. There's gold on one side, copper on the other, and then silver, platinum, palladium fit in the middle somewhere. Gold is the farthest to the left on the precious part of it. And what's gold's total market cap? I think it's about 10 trillion. I might be getting some of these numbers wrong. And the crypto market cap total is about 1 trillion. We just mentioned before about momentum. When something starts moving in a certain direction, people continue for that. The question is, in my mind, is gold splitting buyers with the crypto market, the $1 trillion crypto market? And I think the answer to that is yes, but I'm not 100% certain of it. And I don't think however many thousand years of gold is all of a sudden changing and there's this new paradigm. That being said, within the gold trade, there's moments of doubt. And I think this is one of the moments of doubt. Now, technically, what will change my mind on that, a settle above 1750 in gold futures would go this much in convincing me that perhaps the gold trade's back on again. A weekly settle above 1800 to me will be even more convincing. And by the way, I am long gold. I have a whole dollar hedge portfolio that was doing great, up until the last year when they started raising rates. But I am long gold and would look for spots to get longer gold, provided those two things happen: 1750, then 1800.
Fantastic. Any time frames? No, tough to say.
No, the market's got to tell me. See, that's the problem that a lot of traders make, is that they try to push themselves into a time frame. You must be patient. Trading is oftentimes not exciting at all. Most of the time it's boring as hell, and all you do is look at screens and wait for certain things to happen. My worst trades, even today, was a boredom trade going, yeah, no, I think this is going to happen. No, you have to wait for your signals before you jump in. And that's what I'm going to wait for in gold. Remember that. That's what I said. A settle above 1800, a weekly settle to me would go a long way in making me think the gold trade was on. A weekly settle above 20 in silver, which seems a lot more reachable. Plus, I like the fundamental story in silver as well.
Fantastic. Jim, amazing conversation. Really appreciate you coming on. It's great that we got the chance to catch up here, at least virtually. Next time we'll do it in person.
No doubt.
For sure. Thank you so much. And everybody else, thank you so much for tuning in. It feels like we're going through always a lot of topics when we talk to traders here on the program. And make sure you can follow us on YouTube, follow us on Twitter. But YouTube also gives you the opportunity to hit that speed button, and you can slow down the conversation as well. You can do that, no problem. Or click on the CC button for some closed captioning so you can read along. Leave a comment, leave a like, sub to the channel, and we thank you very much for following.